All right. Let's say we have a trend that's coming down. We're going to come up, create resistance, come down. We're going to come up, create resistance, and come down, right? So we have a trend that's moving down. So we have a bearish trend at this point. So whenever we have bearish trend, what are we looking at this point? We're looking at resistances to form, because once we see a resistance forming, then we can identify that, okay, since we have a resistance forming, there's a very high probability that price can continue pushing down, right? So let's say we have a bullish candle at this point, and then boom, we have a resistance formed. Now we have a resistance form. Now let's suppose this is a 30-minute time frame or a 1 hour time frame. 15-minute may be a little bit tricky, because as we all know, the 15-minute time frame confirmations are weak confirmations. 30-minute and 1 hour are strong confirmations. So let's say, price was coming down, we made support, came up, and now we're creating resistance to possibly continue pushing down. Now, in this case, let's say you're looking at this, you got all the confirmations, and let's say you also have this range, and this is a 35 pip range, and you're like, okay, you know what, I can probably take a sell over here, and I can have a very, very good trade at this point. And you're going to say, okay, you know what, I'm going to take a sell right here. So you're going to take a sell, and this is going to be static risk. So if you're using static risk, you're maybe using your full 1% trade, or you may be using your full 2% trade, and you're taking a sell, and your stop is obviously above the candle, right? Your stop loss is always above the previous candle. You're taking a sell, and you're anticipating price to go down. With your full 2% risk, price goes down, you make some profits, you close the trade, you're like, perfect, I use static risk, and price went in my favor. Now, remember this. This is very, very, very important. Whenever you're trying to use stop losses, your stops always have to go above the previous candle if you're taking a sell, and it has to go below the previous candle if you're taking a buy. So it's not about how big your stop loss is. It's not about where your stop loss is. It's all about where your stop loss is, not about how big your stop loss is. Like sometimes what guys do is like, you're going to trade gold or you're going to trade pound yen, and you're going to turn around and say, oh man, you know what? I have a very aggressive stop loss. That's just not going to fly over here. Right? If you're looking at 30-minute time frame, you're looking at a 1 hour time frame, you have to make sure your stops are above the previous candle if you're taking a sell, and your stops are below the previous candle if you're taking a buy. Because take a look at this. If this candle has to go down, it has to respect the high of the previous candle, and that's where your stop is going to go. It has to respect the high. I can't stress this enough. It has to respect the high of the previous candle if it has to go down. So that's where your stop is going to go. If for some reason price does not go down, and price, let's say, starts to move up from this point, what are you going to lose, right? If we break above this high, what are you going to lose? How much percentage is it that you're going to lose? You're going to lose 2%, because you have static risk, right? You have static risk, so you're going to lose 2% of whatever you risked, okay? That's static risk. Now, let's talk about dynamic risk, which is very, very important here. And usually I use dynamic risk when, when I'm not too sure about certain moves, so I'm going to use dynamic risk. Static risk, most times I use static risk because I can manage risk. And we're going to talk about managing risk in the third section on static risk. So now dynamic risk. Dynamic risk, let's say you have, or you want to risk 2%. You're risking 2%, and you're going to say, okay, you know what I'm going to do? I'm going to break this 2%, my risk, down into two positions. So you're going to break this down into 1% and 1%. That's what you're going to do. You're going to break this down into 1%, 1%, and now you have two positions. The first position, you're going to say, okay, you know what? I'm going to take the first position. Now, these are all hypothetical situations, right? Candle can move up to make a wick, or candle can move down, right? So what happens in this point is that you're taking a sell as soon as the candle starts. So this is where your first position goes, 1%. You're using dynamic risk. Now, if price goes up, this is where your stop loss. Now, if price hits your stop, how much are you losing at this point out of your 2%? You're losing 1%, okay? because maybe you're not sure about this position, you're a new trader, this is a setup that you've been watching for a long time and you're executing on this for the first time, so you're being very cautious of the risk you're taking. So if price hits a stop, you're losing 1%. Now, there are different variations. Sometimes what guys tend to do is that as price retraces, they will add another position, and this is going to be another 1%. They're going to add a position, right? And the stop is going to be at the exact same place. Now, what's the difference between the first position stop loss and the second position stop loss? The first position stop loss is wider, right? The second position stop loss is smaller at this point, but now you have an opportunity to get a better price for this potential sell, right? Now, let's say price goes up, it does not break the high, it respects the high and starts to go down. Now you're in the money. At this point, you're in the money. How many people have, executed on candles that have been moving up, and you're anticipating the candle to make a top wick? And you're anticipating the candle to make a top wick, and then price starts to go down in your favor. You're like, oh yeah, isn't that a great feeling? When price starts to go in your favor at this point, without breaking the high, so we respect the high, you took your second entry right here, price moved in profits, and you're like, okay, you know what? Perfect. I won the trade. Awesome. Right? Now, the second scenario here. Second scenario that happens at this point is going to be, let's say you have taken a sell, right? And this sell is the dynamic risk that you've taken just as soon as this candle opens, so you took 1%. Now, price retraced, right? Price retraced, and you're like, okay, you know what? Price is retracing. I don't want to enter a position as price is retracing, because I find it very, very risky, because if I enter a position and price hits my stop loss, I'm going to lose 2%. So if it hits my stop loss, I'm okay with losing 1%. The number one rule of managing risk is to always be okay with how much you're going to lose. That's the number one rule. Write it down. I'm going to wait. Write it down. Always be okay with how much you are going to lose. Accept that fate that you're going to lose that much, right? So if price retraces, it's going to hit your stop, you're going to lose 1%, so you're not going to enter a second position. What you're going to do is, what I like to do most times is that if I'm going to go for a dynamic risk, as price starts to come back down and start to form bearish, I'm going to enter another position right over here. My second 1%. Because what I'm doing is I'm anticipating that if a candle has a top wick and a bottom wick, right? If a candle has a top wick and a bottom wick, and if price is breaking its own low and trying to go bearish, I'm anticipating that, okay, maybe the candle has made that liquidity wick. Now, some questions may happen that, should this happen in the first minute or the first 2 minutes or the first 3 minutes, 5 minutes? That's besides the point. We're not going to talk about that. When a candle moves in the first minute, 2 minutes, that's basically how many times have you seen that happen. That comes with experience. It comes with intuition, whether you're going to enter in the first minute, 2 minutes, 3 minutes. Over here, we're only going to talk about very simple stuff, and that simple stuff is going to be, let's say, for example, that the first half of this candle made the top wick. Right? And if it starts to go down in the second half, now I'm anticipating that, okay, maybe the first half made a top wick, and now in the second half, we're trying to go down, and that's where I'm going to enter the second position. Right? Now, if, let's say, that I want some extra confirmation, maybe this is what I'm going to do. And this is what I usually do as well. If I want some extra confirmation, and some of you already have that answer in your mind, it's going to be once this candle starts to break the low of this previous candle, second position will go right over here. And guess where the stop is going to go? The stop is not going to go above the previous candle. The stop is going to go above this current candle. And then you can trail your previous stop above this current candle as well. Because guess what? If we're breaking the low, then there's no reason for price to come up and break its own high. Because if price is making a lower high, which is lower than the previous candle, and it's breaking the low to make a lower low, where are we going? We're going down. Okay? So that's what I'm doing. Dynamic risk. We talked about two situations, dynamic risk. First, you enter at this point. Second, you enter as price retraces, but that depends on confidence. The second one, you enter as we try to go bearish, or, sorry, we talked about 3-1, or you enter once we break the low. I find in dynamic risk, what's more useful is that you enter when the candle starts, and then, you know, the second position, if you really want to take a second position, you take that position as the candle breaks the low of the previous candle. That's what you do. That's what I've seen that has worked for me as well. And I've seen, like, you know, a lot of people have done that as well in our group, Slack group, YouTube, whatever. Now, let's say you're entering your 1% at this point. First position goes right here. And now you're going to say, okay, you know what, I'm going to enter the second position as price retraces. But instead of retracing, we create a tiny wick, and then price starts to break the low. In the first minute, or 2 minutes, 3 minutes, whatever, price starts to break the low, and you're like, oh, we're breaking the low. I don't know if it's breaking the low to retrace up. If it retraces up, that's a whole other thing, right? So we're not going to discuss that. If price breaks the low and starts to go down, now you only have 1% running, and you're like, oh, okay, you know what? I had no chance to enter the second position. Now, that has happened to me a lot sometimes too, where I basically had no chance of where to enter the second position. You know, so you got to take it how market gives it to you. That's the bottom line, right? Now, for example, instead of using two positions, you're going to say, okay, you know what? I'm going to be a little bit more risk averse. And what I'm going to do is, I'm going to break this down into 4 0.5 lots, right? 1, 2, 3, 4. I'm going to break this down into 4 0.5 lots, right? So you can basically do the same thing. You can enter the first one right here, 0.5 lot, price retraces. There goes the second one, 0.5 lot. Your stops are right up over here above the previous candle. If candle retraces further more, you're going to lose 1%. You know, you're not losing much. You're just getting better prices, right? If price starts to break the low of the previous candle, there we go. You can enter another 0.5, or you can enter 2 0.5s, or you can enter, you know, a full 1%, making your total risk up to 2%. Go over the section again, right? Making your risk up to total 1%. So there are different variations how you can use your dynamic risk. And dynamic risk is very, very, very powerful because, you know, it teaches you the idea of managing risk. It teaches you the idea of how to average in positions as price goes in your profits or price goes in your direction as it's moving. And the same thing applies for if it's the opposite way, right? If price is moving bullish at this point. But always remember, as we talked about in some sections, that when you're trying to sell resistance, you're only selling resistance when we are in a downtrend. And you're only buying support if we are in an uptrend. Very, very important concepts, right? Very important concepts. Now,